have a session titled The Crisis Around the Corner, Coming to Grips with Fiscal Reality. Outstanding group to discuss this. You know them well. We have Mark Zandi, Chief Economist at Moody's Analytics. Mark, come on up. We have Richard Vague, and our host today, Managing Partner, Gabriel Investments, and Chairman of the Governor Woods Foundation. What you don't know about Richard, which is kind of cool, how many of you get airline points, hotel points, points for anything on your credit card? Raise your hand. He's the king of the credit card affinity. They call the affinity credit card business years ago. And if you have a Chase card, that was his business before at First USA Bank. So Richard, thank you for my points. And Joseph Gagnon, Senior Fellow at Peterson Institute for International Economics. Thank you for joining us. And a fantastic moderator and a great friend of ours, mine, and EIG, Sam Fleming, who is the U.S. Economic Editor for the Financial Times. How many of you happen to read the Financial Times? There you go. There's some parts of the room you got to work on, Sam. Anyway, have fun.
It's a pretty good coverage. Go ahead. Morning, everyone. Thanks very much indeed. It's a huge honor to be here. And we've got a terrific panel who Steve's now introduced to you. Obviously, one of the features of the Trump administration is its willingness to overturn established economic assumptions, the notion that trade wars can be good and can be won, which we're seeing play out in real time this morning. Another one is the idea that tax cuts can pay for themselves and indeed generate sustainably higher growth, which reduces the deficit over time. That is obviously the administration's fiscal outlook is obviously very different from some of the other organizations out there, including the Congressional Budget Office and the IMF, who see continued increases in the deficit and a ballooning national debt approaching 100% of GDP. So that's the debate out there, really. How unsustainable is the US economic outlook and fiscal outlook right now? I'm going to ask Mark Zandi of Moody's Analytics really to help frame the debate we have, because the title of this panel does imply that there's a potential fiscal crisis, and yet I think a lot of people will question really whether a country like the US, which prints its own currency, is really capable of generating a fiscal crisis.
Thank you, Sam, and thanks for the opportunity to be here. Very kind, and to be on this great panel. I appreciate the opportunity. In the 2 hours we got, that's great, right? Nothing worse than an economist for we got 40 minutes or so. The way I think about the fiscal situation is that it's not a crisis in the sense that we're going to hit some kind of wall next year or the year after or even the year after that. I view it as more of a corrosive on the economy, that it is a problem that wears on the economy over time and diminishes the economy's ability to grow. And, economists are really good at rules of thumb. A very good rule of thumb is that for every 1 percentage point of GDP increase in the nation's debt load. So right now, for example, just to give you a number, the nation's publicly traded debt is 78% of GDP. If it goes from 78% to 79%, then all else being equal, long-term interest rates, say the 10-year Treasury bond yield, rises by approximately 4 basis points. Now, 4 basis points is 0.04. That sounds like no big deal, but just take the CBO forecast for the increase in debt to GDP over the next 10 years. We're going to go from 78% of publicly traded debt to GDP to almost 100% of debt to GDP. So 22, that's an increase of the debt to GDP ratio of 22 percentage points times 4. This now really starts to add up. You get a sense of it. And the higher interest rates will start to do damage. And, if you kind of look at the trend lines, and CBO does a very good job of that, and you look out over the next 30 years, the debt to GDP ratio is going to be almost double what it is today. So 30 years from now, it's going to be close to 150% of GDP. So you start doing the arithmetic, and you use that rule of thumb, which, there's a lot of debate about the rules of thumb, but it, kind of gives you a pretty good sense of things. That's a pretty serious corrosive on the economy, and at some point, things start to break. And, precisely when, I don't know. And can things change? Yeah, maybe we find the technologies that drive this economy's growth rates to much higher levels, and we grow our way out of it, or we figure out how to reform our immigration laws and allow more immigrants into the country so that we can grow more quickly. maybe, but you know, a prudent planner wouldn't count on those things. So is it a crisis? No, it's a very serious corrosive, and maybe, you know, given the fact that we don't really act until we're in a crisis, maybe we should call it a crisis. You know? So we act, so we do something, because if we don't, we're going to have a problem at some point in the future.
Joe, are we in a crisis, or is this a corrosive?
I totally agree with what Mark just said. I just think some people say crisis and they mean Greece or Argentina, where there's a certain sudden stop and no matter how much you pay, you can't borrow. That will not happen to us. It's more what Mark said, and gradual and over time, it accumulates into something that does matter, and it actually makes the budgetary options of our next generation harder. You know, basically, our children are going to have a harder time. They're going to have to pay more interest out of their taxes and have less to pay for other things, and that will be bad. But there's no date at which, you know, it shuts off. It's just a gradual process.
Richard, you wrote a book, obviously, talking about economic disasters, and your focus was really more on private sector debt than public sector debt. But let me ask you first about public sector debt in the US. Do you agree with the other two panelists that we're basically on a sustainable, if long-term, damaging trajectory, at least in terms of where we are now? And if that's not a problem, how do you assess the private sector indebtedness right now?
I think Mark and Joe have put it well. It's not going to lead to a crisis. In fact, when we look at all crises over the period from World War II to the present, and we use, for the Reinhardt and Rogoff database, for example, and we weight the crises by the GDP of the country that had the crises, it's only about 3% of all crises on a GDP-weighted basis that were sovereign debt crises. And they tended to be marginal economies, less developed economies, that did things like let their current account deficits grow and borrow in a foreign currency and other rookie mistakes. And on the other hand, the predominant form of crisis comes from financial crisis, which is rapid growth in private debt. Banks overlending, it's rapidly growing, that definitely leads to crisis. I'd make one other observation here that we've spent a lot of time studying lately, and that is, people do tend to think, not all people, but some folks, tend to worry about interest rate increases as a result of growing government debt. And we find no correlation there at all. And in fact, it may be the opposite. If you look at total aggregate debt to GDP since World War II, whether you look at it in the United States, whether you look at it in the European Union, whether you look at it in Japan as an example, interest rates increased all the way to the point that the world stopped deleveraging after World War II, which is about 1976 in Europe, 81, I believe, in Japan, and 82 in the United States. Since that point, in all three of those economies, if you will, debt has been growing very rapidly, and those have been the very periods that we've seen the long-term secular decline in interest rates. So, it's kind of the inverse of what people generally assume or imagine.
When we look at the IMF's recent report on the US economy, and this is a report which focused heavily on the fiscal position and was extremely gloomy about it, one of the risks that they talked about was actually of rising interest rates. Their view was that because we're an economy which is at full capacity, running at full tilt, you could start seeing inflation. And if you start seeing inflation, you could see the Federal Reserve having to raise rates more than people expected. And that could have worldwide repercussions, damaging financial markets elsewhere, especially economies which may have borrowed too much. Joe, let me ask you first of all, do you see the risk because of the arguably overstimulative fiscal policy right now that we could actually be on the cusp of a surprise on interest rates and inflation?
I do. I don't know how you define cusp. I see that as something that would be maybe 2 years away. not this year or next year. But I think the Fed was on a nice, before the tax cut and spending increases of the past 6 months, the Fed was on a nice glide path to slowly raise interest rates, to slowly bring the economy into a soft landing. And this large tax cut and spending increase, which they had not anticipated, I fear is supporting growth to be stronger than the Fed would have wanted already now and for the rest of this year and next. But they're not willing to tighten faster yet because they have made the mistake of being too tight for too long, that they want the next error they make to be the other sign, and they'd rather have inflation overshoot than undershoot. But I fear that they will get that overshooting because this fiscal policy is badly timed, and sometime in 2020, I guess, they will have to tighten a lot more. And then it becomes a question of whether there's a recession. We have never, since World War II, had unemployment as low as it's projected to go and not had a recession soon after.
Mark?
Yeah, totally agree. I think long-term interest rates rise over long periods of time if debt loads rise. So I think to take the counter to Richard, the best evidence or best research here is with regard to the effects of quantitative easing on the economy, which is very similar. The Fed's out buying bonds, and they've done research and showed that had meaningful impacts on long-term interest rates. And I think we can use that as a basis for saying, yeah, this is going to have some impact on long-term interest rates going forward. But in the other aspect of this, is what you're now bringing up, is in the short run, the timing of adding to the deficits is very inopportune, right? The economy has a 4% unemployment rate. All estimates of full employment are unemployment rates that are 4.5 to 5. We are past full employment. If you just do a little bit of arithmetic, the unemployment rate, given all this fiscal stimulus, deficit finance tax cuts, deficit finance government spending increases, will push the unemployment rate into the low 3s. Now that sounds great, and we want very tight labor markets, but that's unsustainable. We've only been in a world of low 3% unemployment 2 other times in economic history. One was in the middle of World War II. The other was in the early 1950s when 10% of the workforce was on the Korean Peninsula fighting the Korean War. So this is an unsustainable situation, and it will result in wage and price pressures. The Federal Reserve will have to respond, and I do think recession risks are very high as we make our way into the early part of the next decade when this fiscal stimulus will fade, because it will. You know, the juice we're going to get, and this is temporary juice we're going to get from these tax cuts and government spending increases that are deficit financed, are this year going into next year. By 2020, it's all gone away, and you're left with higher interest rates and higher inflation, and I think recession risks will be awfully high.
Richard, is that low rate scenario that you spelt out too benign looking ahead for the next few years? Is there a risk that we can
Yeah,
be
I mean, again, I would agree with Mark and Joe. The interest rates, which have been artificially low for the last few years, unnecessarily artificially low, are going to move back up a little bit. But there's a paradox here, and that is there's so much aggregate debt in the world today in ratio to GDP that interest rates have much more braking power or braking effect than they did. I can't remember the exact year, but let's say a couple of generations ago, the aggregate debt in the world was, a third or a half of what it is now. So if we have 3 times more debt to GDP globally than we do now, than we did then, a 1% increase in interest rates has as much braking power as a 3% increase in interest rates did a couple of generations ago. So I think there's more of I don't know where that ceiling is, but I think, for us to expect interest rates to go up 200 or 300 basis points, it's probably well within the realm of possibility. I think beyond that's pretty difficult to imagine.
So let me put the administration's case here, which is that the tax cuts and the stimulus that's being currently provided is going to generate a sustainable uplift in trend growth in the United States. And we are seeing this year improvements in investment. If that sustainable improvement in growth to 3% or more over a long period of time is borne out, the deficit could start to come down and their figures could be borne out. Mark, do you see any possibility whatsoever that much more positive outcome could actually come true, or do you just think their numbers don't make sense?
There's no possibility that's going to happen. None. You know, the guys who do this for a living and really look at this and really, you know, work through the numbers. You know, CBO does this work. You know, Moody's Analytics does this work. There's, you know, a dozen different people. Actually, you can go to the CBO website. They did a really great study where they brought together all the estimates from folks that do Goldman Sachs and JP Morgan, so forth and so on. And the consensus, and it's a very strong consensus, there isn't much distribution around the consensus. The consensus is that this tax law will raise GDP by 0.7% on average over the next 10 years. So think about that for a second. So 10 years from now, GDP is going to be 0.7 percentage points higher than it is today. Divide by 10, so it's going to add 0.07 percentage points to growth over a 10-year period. So we're going to go from 2% per annum growth to 2.07% per annum growth, which is, you know, I'll take it, but it's pretty costly. The cost is now $2 trillion added to the nation's debt. So we just bought 0.70 percentage points of average annual growth for $2 trillion in debt. And, you know, the link, the channel, the intuition behind the lowering of tax rates to stronger economic growth are correct. That is, if I lower marginal rates for businesses, all else being equal, it lowers the cost of capital and that they're going to invest more. But that takes many, many years to play out. I mean, you have to, investment adds to the capital stock, which improves productivity growth, which leads long-term growth. That chain of events occurs over periods of decades, not periods of years, if we, you know, stick to it. And it also assumes that it's not deficit finance, because if you throw in the deficit finance and the higher interest rates, you wash out the benefits of the lower marginal rate. So this is, we've been down this road many times. We've studied this very carefully. It is not going to happen. We are not going to get the kind of growth rates, not even close to the kind of growth rates that the administration is expecting to get from these tax cuts.
Richard, you're in charge of a venture capital fund. Do you see changes in corporate behavior which suggests that the tax cuts could release some kind of step change in investment, which helps to resolve some of the problems we have in the U.S. over productivity? And
it helps. It's not a structural or systemic type thing that's going to make any difference. So I tend to be in Mark's camp on this. We'll see a little positive news, not a lot. And you know, we do see, you know, our database, we have 47 countries that our data at least goes back to World War II on these, and politicians routinely claim that, you know, we're going to have do this or that or the other to stimulate growth, and that's going to pay for an increased federal deficit, and because of this, over a period of time, we're going to see a reduced deficit or debt level. It never happens. It never happens. So I kind of agree with Mark.
Joe, let's think about what could be done about this this corrosive situation then over the longer term. The IMF's report focused on the need to actually raise tax revenue. It said that actually the US isn't raising enough tax revenue given the size of the deficit and debt. The administration obviously has been focused on cuts to some areas of discretionary spending. What we haven't seen is any attempt to deal with some of the longer term mandatory programs, including Social Security and Medicare. How would you, if you were designing a roadmap to getting to a better place, how would you advise the government to go about doing this?
Well, I certainly would go for more tax revenue. I think that's essential, and whether you do that by reversing some of these tax cuts or perhaps moving to a more of a consumption-based tax, if you can do it somewhat progressively. But on the spending side, I think the main area that I would want to go after is healthcare, because we waste so much health spending, and a lot of that is government health spending, and so that's actually a significant, people talk about cutting waste and abuse, and it's normally a joke, but in healthcare and in government spending on healthcare, there really is low-hanging fruit that could be achieved. I mean, you know, several percent, percentage points of GDP, 2 or 3 percentage points of GDP is possible. That's real money. But you'd have to be very serious about incentives to move people into managed health maintenance organizations and get rid of middlemen and negotiate with drug companies and things like that, which politically are difficult.
I mean, a few years ago, Pew did a survey of public attitudes to the deficit. I think back in 2013, around 72% of the public saw cutting the deficit as a top priority. That's fallen to around 48% at the beginning of this year. So the public now seem to think cutting the deficit is much less of a priority than they used to be. Mark, first of all, what do you think is driving that change in public mood towards the deficit? And does that make it more difficult to foresee the kind of difficult measures that Joe is talking about actually ever coming true?
Can I also play king for the day and tell you how to solve the problem, or can I do that too?
Blaze.
Yeah, I need a week though to solve the problem. I think in terms of perception, we've until recently been through a very obviously difficult period. It's only recently that the economy has gotten back to full employment, and we've had a full decade of significant financial stress. I mean, the unemployment rate peaked at 10%, took many years to get back to full employment. So I think in that context, people, rightly feel they need support and help, and they're willing to live with tax cut. They want tax cuts and more government spending benefits to help through this very difficult period. So my guess is that is behind the change in attitude. Also, people take cues from the leadership, the nation's leadership. The nation's leadership is saying, don't worry, this isn't a big deal. And I'm sure some people are taking their cues from that. So I think I'm sure there's other reasons, but those are perceptions. But perceptions are a fickle thing, and they change very rapidly. Just go back into the 1980s. We had massive tax cuts in 81 and in 83, and we took it back in 86. And so the perceptions around deficits and debt will change as deficits and debt will rise. And by the way, deficits and debt are going to rise dramatically. So, last year the deficit was $665 billion. This year it's going to be close to $800 billion. Next year it's going to be $900. It's going to be close to $1 trillion. And after that, we're going to be over $1 trillion forever. Unless we change something. So those perceptions will change. But if they don't change, then if this is not a crisis or even a corrosive in the minds of people, then there's no legislative, no political will to change it, and we won't. We won't until something breaks, and that's a problem for the next generation. Can I play king for the day for a second? Okay.
Go for it.
So this problem can only be solved by both cuts in future government spending and tax increases. There's no one or the other. And by the way, tax revenues as a share of GDP are now well below their long-term averages. And it's falling fast given the tax cuts. Government spending as a share of GDP is pretty close to its long-run average. But nonetheless, you do the arithmetic, the aging of the population, that's going to continue. We need to do both. So on the tax side, the most, I think, straightforward thing, and there's a lot of bipartisan support at least from academics, not from politicians, is a carbon tax. We need a carbon tax. It generates a lot of revenue and it solves a lot of other problems. Obviously there's issues with it that we have to resolve, and we can talk about it. The second, on the spending side, the real problem is definitely healthcare costs, but it's also just longevity. We're growing older, and so we need to allow the retirement age to increase. There's also issues with that. Obviously if you work in construction, manufacturing, your ability to work as you age are lower, and we can address that. But if we have a carbon tax and we allow for longer, we extend out the retirement age, those two things would solve our problem, and we address our long-term fiscal issues.
Richard, I'm going to get you to respond to that, but I also want to ask you specifically about the private sector. Where do you see in the US right now the key risks when it comes to private sector debt in particular? Because actually, you could argue the picture now is a lot better, despite the growth we have seen in nominal debt, than really it has been for a number of years. Certainly, the levels of indebtedness that we see in the consumer are not as high as they were before the crisis. Where do you see the key areas of concern in terms of private sector indebtedness in the US?
We study this very, very closely. And debt levels in the United States, and the thing we really look at is the ratio of debt to GDP. So if debt and GDP are growing in lockstep and the ratio is constant, to us that's very comfortable area. And that's in fact what's been happening. It's only really in the last year to 18 months that we've started to see a little bit of a tick up in private debt to GDP. And we think if private debt to GDP grows more than like 3 to 4% per annum for 3, 4, 5 years, you're probably going to have a crisis. So we're well below that. You know, the area of the world that's a deep concern is Asia, China especially, but South Korea, Australia, a number of other countries that are effectively satellites of China's. Now, if you look kind of within sectors in the United States, there's probably a little overlending in real estate that's being done. Real estate's the biggest borrowing sector of all, so it's the one you'd want to watch most closely. There's a continuing problem in student debt and a couple of other small consumer lending categories that should be addressed. But student debt is about $1.4 trillion. Private debt as a whole is about $28 trillion. So it can be a problem for students. In fact, it's an egregious problem for students. It's not a systemic risk issue. So I don't really see systemic risk issues in the United States right now. I'll make one little editorial comment, and that is the Federal Reserve in the Z1 report that is kind of our Bible keeps track of private debt and is our way of keeping track of these things. And we have noticed as more lending is being pushed out of the conventional banking system and into BDCs, business development corporations, private equity lenders, you know, that number, the debt number that's, you know, in those categories may be as high as $1 trillion. It's not clear to us how much of that is actually captured in the Z1. When we talk to the Fed staff, they would suggest that it's not fully captured in the Z1. So there may be an element of private debt growth that's occurring right now that's not being captured, and that's a concern.
Yeah. Joe, one of the concerns that you hear from policymakers is that the continued low rates policies of central banks around the world is going to foster the kind of dangerous build-up of private sector debt that we saw before the crisis. Would you agree with Richard that actually, focused on the US right now, most of the indicators are fairly unconcerning, or are there areas where you think there could be systemic risks beginning to build again?
I would defer to Richard on that because I don't see areas of risk, but it's not something that I focus on a lot. So it's interesting to hear this other categories that the Fed might not be capturing. So I don't know, but I think I see risks are more international in terms of we still have the phenomenon that corporations, especially in Argentina and Turkey, and other countries are borrowing dollars, and when the Fed raises interest rates, they have trouble paying back those dollars. And this story plays out over and over again. It's what causes the IMF to go into, you know, crisis lending programs. You'd think people would learn the lesson, but they don't seem to. But I mean, there has been some improvement, but it's not. It's still a risk.
Mark.
I would agree with Richard that aggregate credit growth is very consistent with nominal GDP growth, so the debt to GDP ratio, and I'm talking about non-financial corporate debt, so, and this is US, excluding the public sector and excluding the financial sector. And so if you look at the aggregate statistics from 30,000 foot, you'd say, you know, no big deal. Everything looks okay. Things feel okay to me. Richard's right. There are pockets of areas where there's some concern. You mentioned student loan debt. There's been some concern about subprime vehicle lending. But these things, a little bit on the retail card side, you probably know better than I, but these things are too small to matter in the grand scheme of things. And I do agree with Richard that my view is that the problem, every recession at its core has a problem somewhere in the real economy that's mirrored in the financial system. It's exposed by the wage and price pressures and rising interest rates, but there's some fundamental issue underlying the recession. I think this go around it will be in the so-called shadow system. So as Richard points out, you take the financial system, you've got the depository institutions, the banks, the credit unions, what savings loans are left. Those are depository. They're rock solid. Post-crisis, they've raised a lot of capital, liquidity is good, risk man. They buy my tools for risk management, so we got no problem in that area. So we're good. But the shadow system, which is the other half of the financial system, where you've got a melange of all kinds of things going on, BDCs being an example, are very opaque, very hard to know, and I think we need to spend a lot more energy on it. And there's just, there's one banking adage that has always worked. I don't know if you've heard this adage, Richard. If it's growing like a weed, it's probably a weed.
I had someone say that to me once who was considering acquiring my company. And my answer was no.
I'm going to get, we've got a great panel here, so I want to give you the audience an opportunity to ask some questions too. While you're formulating your questions, let me ask one more policy question, which is back to public sector debt. We do have a position now as the deficit and debt continues to rise, this question about how fiscal policy will respond when the next recession hits. And will, once more, central banks be the only game in town when it comes to stimulating the economy? Given the continued increase that we expect in public sector debt, I'd like to ask all three of you, do you think that once again we could be in a position where we're over-reliant on central banks to keep the economy going when the next recession hits? Joe?
Well, in my view, we would have fiscal room if we wanted to use it, even with the path we're on. I mean, it's not ideal, but I don't think we're going to be shut out. I mean, Japan has got twice the debt that we have, and there's no sign that they're running out of room either. I mean, it's not good, but I don't see a hard limit. But the problem in the past recession and probably in the future recession is going to be getting the political agreement to actually do that, and that's what forces all the action on central banks, it seems to me, is when the politicians can't agree on a fiscal response.
Okay. Richard?
You have to examine, to a certain extent, what really is going on in a recession, I think, to answer that question. If for example, it is, and I expect a mild recession in the next couple of years. I think it's going to be kind of a garden variety recession, not a crisis. And let's just say, for example, it's a function of real estate, overbuilding. So at that point in time, we've got too many apartments, we've got that don't have enough tenants, and we don't have too many office buildings that don't have enough tenants. We have too many houses that might be on, whatever it is. It's let's just hypothetically say that that's what happens. The real solution in that case is time. You've built too much of something. You got to lay folks off because you've kind of gotten ahead of yourself. By the way, I learned this at one of Mark's conferences where he detailed the math of this pursuant to the 2008 crisis in a very enlightening way. But at that point in time, it's really time. There's no magical. So if you're doing something from a monetary standpoint, what you're doing is you're lowering rates so the borrowers with those empty buildings have less pain for that period. And if you do something from a fiscal side, you're going to try to get folks to build government buildings or projects to kind of absorb rising unemployment for a period of time. But in both cases, all you're really doing is waiting for overcapacity to be absorbed.
I think we have less fiscal space to respond to a severe financial crisis. Just to give you a sense of it, the fiscal response to the Great Recession was to add almost 40 percentage points of debt to GDP. We were at 40% debt to GDP ratio publicly traded, now we're close to 80, right? So we needed that fiscal juice to buy time to kind of manage our way through as well as we managed through. It was obviously still a very difficult time. And the Federal Reserve responded very aggressively. And I think if we got into a similar kind of situation, we wouldn't have the same fiscal capacity that we had this go around. It'd be more difficult to ante up and expand the debt load sufficiently to respond. And adding to the concern is the fact that the Federal Reserve now is operating with an interest rate that's much closer to the zero lower bound, right? So the need for fiscal response would likely be much greater if we got into a similar situation than it was in the last go-round, just because of this world we now live in with much lower interest rates. But the thing that really concerns me is not the United States with regard to this. It's really Europe. Europe has no fiscal space, has zero fiscal space, and their interest rates are still negative. So the European Central Bank still has a negative. So think about what happens if Richard and I are right. In 2 years we go into recession. By the way, if we go into recession, the world goes into recession. We're still the largest economy on the planet by a good order of magnitude, and we'll take Europe with us. What in the world are they going to do? How are they going to respond to that? So I think the real fault line in the immediate future isn't here in the United States. It's in Europe, and it's around their very high debt loads.
Great.
If I could, so I think that I agree, except I think the European fiscal thing is a self-imposed problem given the rules of the euro area that, they could work out a better fiscal system, they could raise more debt. It's just that the rules they have now don't allow it. And maybe it's the one disagreement we've had on the panel, but I actually think if we had to do another 40% of debt in the US in a massive crisis like we just had, which I don't expect will happen for many, many years, but if it did, I think we could do it.
Okay.
Yeah, if you line it all up, our federal debt to GDP is getting around 100%. Japan's, it's like 240, 250%. So the thought that, we're coming up against any ceiling there is, I don't think, borne out by observation.
Okay. Let me take a lot of hands going up. Great. Let me take 3 questions at once, and then we can put them. First, right at the front. And please do give us your name and affiliation, and keep it as a question rather than a speech.
Alejandro Becerra, National Association of Hispanic Real Estate Professionals. Mark, you talked about your expectations of tax cuts, how limiting economic growth would be. In addition, Dr. Rivlin pointed to an aging workforce as being a limiting factor to job growth and economic growth. If you can all put your king for a day head again, what will it take to actually achieve higher levels of job and economic growth?
Thank you. Another question, please. The table, yeah, that's right. Thank you.
Thank you very much, Larry Checo. A quick hypothetical. If the Congress was willing to throw upwards of $2 trillion into national debt for a tax cut, would it have been worthwhile for them to turn the whole situation upside down and give 83% more to the working class and middle class, which would spend that money and get away with the middleman? I mean, the middleman is the top 1%, and we're hoping on trickle down again. And once again, we're at the mercy of strangers to bring down that, let them. Why didn't they just give it to the middle class that needed it? It would have given money to corporations who say, well, there's no growth, growth is slow, growth is slow because if I've got a family to feed, I'm going to feed my family before I buy a new car. So I'm asking as a hypothetical, would it have been better?
Thanks.
Thank you.
And final question right at the front here, please.
I'm not going to be able to remember what all the...
Thanks.
Hi, my name is Farzan Illich. I'm wondering, how does military spending figure into all this? So let's say instead of trying to get the Europeans to waste more money on this, if we spend less money and offset it by investing in real security, because military solutions increasingly sound like an oxymoron, and we need things like mental health and things that could really make us more secure.
Okay, thank you. Right, first question about Alejandro. Mark, I'll give to you the impact of what would you do if, as king for the day to try and get the growth rate up in the context of an aging workforce?
Sure, thanks for the great question. The most obvious way is to increase immigration. It's not to reduce immigration, it's to increase immigration. Clearly, it's ideal if you have highly skilled, more educated, the best and the brightest come here, and we should be very welcoming. But in my view, we need immigrants of all skill sets, that going forward, given the demographic realities you articulated, the aging of the population, the retirement of the boomers, I don't know about Joe. Joe looks very young, but the Richard and I are out of here, pretty shortly, the way things are going. So we need more immigration of all stripes, and that is the only way to significantly increase the growth rates of our economy on a sustainable basis anytime soon. Tax cuts just aren't going to do it to businesses. Even well-designed tax cuts that are revenue neutral and don't add to our deficits won't do it. If we want to go from 2% growth per annum to 3% growth per annum, the only way to do that is to welcome the world, not push the world away.
Okay. For the last two questions, we have 15 seconds to answer them, so we obviously can't answer them properly, but let me give them both to Richard and Joe. One on the question of how the tax cuts were oriented and shouldn't they have been given to the middle class, and the other on how we think of military spending in the context of the rising deficit. Joe first.
I'll tackle the first one, which is a good. Look, I think it was a bad idea, personally, to have tilted the tax cuts so much for the wealthy. But because of inequality is already a problem in America, and that only makes it worse. But the one saving grace of that is that those people aren't going to spend it. And that actually is, right now, not a bad thing because we are already at full employment and, if anything, beyond. The best thing for workers is a long period just below full unemployment, whatever, the natural unemployment or employment, whatever. The long period of the economy above potential, but not by much, to gradually get more people into the workforce. I think the problem here is if you had pushed more of the tax cuts to people who would spend it, you're going to have the economy overheat too much, cause the Fed to tighten and cause a recession. That would not be good.
Richard, last thought to you.
Yeah, if you were going to have a tax cut, I'll disagree mildly with Joe, who's smarter and better than I am. But if you were going to have a tax cut, it's almost like we blew it, by giving it to the very wealthy. We should have given it to folks that are, I think the statistic is somewhere between half and 2/3 of the folks in this country can't afford to miss a single paycheck. I mean, it's an astonishing fact, and that's where I would have directed it. And, as I model it out, tax cuts, in fact, can pay for themselves if folks spend the money, and if they spend the money all the way through. I spend it with you, and you take your increased earnings and you spend it with the next guy. We actually do recover most of that in increased economic activity. If the folks that get the tax cut just pay down debt or put it in the piggy bank, the deficit increases by that very amount. So I think it was a blown chance. It was a missed opportunity.
A blown chance to miss opportunity is a great note on which to end this conversation, given the next speaker who can take up that theme and no doubt has a very different view on it. Thank you very much indeed to my panel for a really interesting conversation.
Big round of applause for the panel.
Thank you so
Mark
much.
Zandi, Richard Vague, Joe Gagnon, Sam Fleming. Put your hands up if you're going to subscribe to the FT now. Who's going to cancel their subscription to the FT? Thank you, Sam. Thank you, guys. Take your hellos off stage, please. We got to move forward. So I have some very important news. How many of you are going to stay for drinks at 5 o'clock? Lots of you, yeah, okay, great, cocktails. So let me tell you, we have, John Lettieri, this